All right, so in today's video, we're going to be looking here at chapter 23, which is going over relevant costing for managerial decisions. So this is where we start to pull together kind of everything we've talked about all semester and really start to look at some of the most common questions that we're going to have to start answering when we move into those managerial positions. So should I make this component or buy this component? Should I sell this item now, or should I continue processing this and make it into something better? All right. We're going to look at all types of decisions like that here in this chapter. So we'll go ahead and get started. So here in chapter 23, the very first thing that we have to realize is how this decision-making process even works. So it breaks out basically into 5 steps. The first, of course, very important, you have to define what we're actually trying to do. So what is my task? What is my goal? That is my first step. If I don't have that done, I can't really proceed because I don't know what the end goal is. I don't know where I'm heading, right? It'd be like taking out on a road trip and not knowing your direction, right? You just can't do it. It's not very effective. For my next piece, then, once I know what my task is, what my actual end goal is, then we have to identify the actions or the alternatives at our disposal. So what options could I actually evaluate here? So for example, if I was your manager and I came to you and I asked you to make an adjusting entry that you knew in your heart, based on the accounting rules and procedures that we know, you knew that what I was asking you to do was not correct, right? You knew that what I was asking you to do essentially was to commit fraud. Well, even in that scenario, you have at least 2 options, right? You can either, just at a baseline, right, the 2 most obvious options in this case would be then, one, you do what I've asked you to do. You subordinate your judgment and you do what I've asked. Even though you don't feel good about it, even though you're pretty sure this isn't right, because I'm your superior, for example, you decide, sure, I'm going to go with it, right? And so you go ahead and do the thing. The alternative option is you say no, and you either don't do the thing, or if I continue to push on this point, you actually resign and step away from the organization because you know that what is happening here is not right. Now, certainly there are more options than those 2 things, but those would be, for example, the 2 alternatives that we can very clearly see in this case. Well, after you've identified the 2 alternatives, you then have to identify essentially, well, what information is actually relevant here. So if I go through with this, am I putting my career on the line, or am I putting your career on the line? Whose career is at risk here if we go through with this, right? Might be one thing you want to consider. On the other hand, you might say, well, how would I feel if my family knew that I did this thing? Or how would I feel if my other coworkers knew that I had engaged in this improper activity, right? And so all of this, in this case, in this chapter, we'll be looking at very different things. We'll be looking at, which costs are actually relevant. And that will be a main idea in this chapter. But the idea with relevancy here can span many different areas, right? In this chapter, we'll be looking at more a cost side, of course. But truthfully, this type of decision-making process can be applied to any area of your life, right? And that's why I started with the more ethical or the more moral type dilemma. But of course, in this case, in this chapter, we'll be typically evaluating 2 decisions. So should I make this product, for example, or should I buy this component piece? Well, in that case, the only thing that I really care about are the things that are different between the alternatives. Because if it is the same between the 2 alternatives, then it doesn't matter which one I pick. So when I actually start making those decisions, I want to be looking at what's called the incremental cost. And we'll see that in just a minute. Now, once I've gathered all this information, once I've thought about all the consequences, once I've identified the actions, once I've done everything I can, at that point, I'm then able to make my decision to select that course of action. And then finally, once I have actually selected that course of action, I will then analyze and assess if that decision, if that action actually achieved what I wanted at the end of the period, at the end of the cycle, whatever it is. But we'll need to circle back on that and see at the end, did we hit my target? Did we achieve what we set out to achieve? Now, in this case, we're going to be looking at our relevant costs and benefits. So there's a couple of things here. So these are the costs that, of course, are applicable to an individual decision, to a particular decision. And these are the costs that we will want to consider. Another thing that we want to consider here is this phrase that I'm about to highlight. Let me grab my marker real quick. But it is that these costs are avoidable, right? The costs are avoidable. So if the cost is avoidable, then that means if I choose an alternative other than this one, I do not incur that cost. Because of that, that is a portion of the cost I do want to consider. Because by choosing alternative A, I incur all of the costs that are only associated with alternative A. But then if I turn and choose alternative B, I'll incur only the costs associated with alternative B and none of the costs that would have been associated with alternative A, assuming these are truly avoidable costs within each category. Now, certainly there may be some fixed costs that overlap the alternatives, right? But those tend to not be relevant because if it will be the same, regardless of which alternative I choose, it's not truly avoidable. And so I will not want to influence my decision based on that portion of my cost. And another thing here, of course, is that these are future costs. So that's important that notice differ between the alternatives. Very good. So basically, this breaks out into three different areas. We have what are called sunk costs, out-of-pocket costs, and of course, opportunity costs. So we'll go into a little bit more detail on those here on our next slide. So in this case, we see first that my sunk costs, these are costs that are the result of a past decision. So these are things that we cannot change based on current or future decisions. And because of that, these are irrelevant. So the idea here is I've already incurred this cost. Because I've already incurred this cost, I cannot recover that. So this cost will not be relevant. So this could be something like the cost of an asset that you've already purchased. Well, that cost has already been incurred. Regardless of if I keep the asset or sell the asset, I'm not changing that initial purchase. You might also see things like the depreciation on an asset, right? It's already happened. Regardless of what I do going forward, I'm not going to be able to recover that piece. So these are our sunk costs. And what we need to understand about sunk costs is these are irrelevant to my current and future decisions. Now, this is an area that people commonly mess up in practice, right? It's very easy in a textbook to say sunk costs, past decision, we should not consider them going forward. But have you ever heard the expression throwing good money after bad? Well, that is primarily talking about when people are dealing with sunk costs. It's very difficult in practice to realize that I've invested $150 million in this new plant, but now I recognize it will not be profitable, right? The best thing I could do is cut my losses off right there and go do something else. But at this point, once I put that much of an investment in an area, it's very difficult for me to look at that and go, I understand it's not profitable and actually walk away. So these sunk costs typically aren't irrelevant whenever people are actually making decisions, but they should be, right? This is a very common area that people mess up all the time in practice, is treating sunk costs as relevant. Regardless of what I do, if I've already put in that $150 million into this new plant, I'm not getting it back. So when I'm actually making my decisions on how to progress forward, that 150 million shouldn't matter to me any more than a 50-cent transaction, because at the end of the day, that money's gone. I'm not recovering it. I should ignore that. It's very difficult to actually apply that in practice, though. Now, my next type of cost that we want to look at is what is called an out-of-pocket cost. So out-of-pocket costs, of course, these are, notice, future outlays of cash associated, notice, with a particular decision. These, of course, will be relevant. And the reason for this is primarily because they are tied in with one individual decision. So these are the costs I'll have to actually pay under each alternative. So if I choose alternative A, I'll pay the out-of-pocket costs associated with it. And if I choose out-of-pocket, or if I choose alternative B, I'll pay those out-of-pocket costs. But because those are very likely for different things, then we will see that being relevant. And finally, we're going to look at opportunity costs. So this is more of an economics type thing, as well as sunk costs, truly. Both of those are very common topics in your economics curriculum. But opportunity costs, of course, notice the potential benefit that has been given up when one alternative is selected instead of another. So these opportunity costs, notice, are relevant to decisions. And management must also consider what are called the relevant benefits. So I kind of missed on my highlight there, but no big deal. So these are my relevant benefits. Now, in this case, the opportunity cost, as we said, is the actual benefit given up as you select one alternative instead of another. For example, you chose to attend class today. You chose to watch this video today. Well, when you made that decision, you gave up the ability to do something else with your time, right? You decided that this was important enough to you that it was worth giving up maybe a nap or going to hang out with friends or doing something else. Or maybe you didn't take that overtime shift at work. Whatever it is, whatever you gave up to attend class today, to watch this video, is an example of an opportunity cost. Another opportunity cost, for example, would be you chose to register for say, summer school class or a full semester class. But when you did that, it now means you can't work as many hours at work. Well, those hours you gave up at work are an opportunity cost because you chose to forego that benefit for something else. So the way this really works then is if I'm really wanting to make a good decision, I should probably consider the cost of what I've given up. So when we talk about something like the cost of attending college, right? It's a very popular topic. Out-of-pocket costs, right? The amount you're actually paying is certainly different than the total cost you're incurring. Because let's just say, to make the math easy, that regardless of which university you go to, we'll just pick a nice even number. We'll say it's $15,000 a year to attend college, right? So you say $15,000 a year, you get a 4-year degree, that's $60,000, right? That would be what I would call the accounting cost, right? The actual out-of-pocket cost, right? The amount you're actually having to pay. But odds are, if you had not come to college, you would have had a job doing something else. So the wages that you lost over that entire period of time, that 4-year period, that would be the opportunity cost, right? When you add those two together, you'd actually get what we call the economic cost, which is your actual cash cost or your accounting cost plus that opportunity cost of what is given up. So certainly if we're making decisions, right, if you're trying to figure out if I should go to college for this degree or that degree, and you're really wanting to look at the finance side of it, it's not enough to just look at the actual cash you're having to pay. You also should consider the cost of what you could have been doing in the meantime. And so that would be that opportunity cost, anything that is given up when you choose one alternative over another. Very good. Now, in this case, our first decision in this chapter will be what we call the make or buy decision. So we'll be seeing several different decisions here in this chapter. The first is make or buy. We'll then look at sell or process further. We'll look at sales allocation with constrained resources. We've got quite a few options or quite a few decisions in this chapter, but our first one here is make or buy. Notice, this will need to be looking at my incremental costs because those are the ones that are important when we make this decision. So not the total cost, right? The total cost, sure, I need that for other stuff, right? But when I'm actually trying to make this decision of if I should make a product or buy a product, then I should only be looking at, notice, the incremental cost. So be very careful there, right? And this is a common mistake students make, is they will look at the total cost instead of the incremental cost. Make sure you're only considering that incremental or that additional cost to produce the product. Now, the cost to produce the item, notice, must include all the things we've looked at all semester, direct materials, labor. And you'll notice here, for overhead, it's not my total overhead. There is a difference, a key distinction here, and then this is only my incremental overhead, right? Very common mistake. Students will give me the direct materials, labor, and total overhead. But you'll notice that's not what I need when I'm making this decision. What I need is that incremental piece. Now, there is a key note down here at the bottom. Notice we should not use the predetermined overhead application rate to determine product cost in this decision. So here's the problem with using that total predetermined overhead rate. It includes the total amount. It does not include only the incremental amount. So we'll go ahead and see this work out. So in this case, our company Fast Track currently makes a part, and part's number 417, and assigns overhead at 100% of direct labor cost with the following unit cost. So materials 45 cents, labor 50 cents. Factory overhead, you'll notice 100% of labor is another 50 cents. So my total cost to make this product is $1.45. We are approached from an outside supplier who tells us that they can make this product for me for $1.20. So here's the deal. At that point in time, what my total cost is to make the product is $1.45, but my actual purchase price is $1.20. Well, right off the bat, you look at that and you say, well, man, that looks like an easy decision. We should certainly take them up on that and buy the product. Well, the question really is, at what point would I be able to continue to make the product? So if I am evaluating this using that predetermined overhead rate, where this is 20 cents in that make column would be 50 cents, giving me a total incremental cost of $1.45. But that's not what's there. You'll notice what they're showing me here, this overhead cost is just that incremental portion of my overhead. So this will be any incremental overhead costs to make the product. This might include, of course, any additional power to operate the machinery, any extra supplies that we might need, any cleanup cost or materials handling, quality control testing, anything like that specific to making the product comes out, in this case, to 20 cents per unit. Well, if that's the truth, then my incremental cost is only $1.15, which you'll notice is less than the $1.20 to buy the product. So what we'll see then is that if my incremental cost to make, in this case $1.15, is less than the cost to buy, in this case $1.20, then we will continue to make the part, and that is exactly what we see here. So we will continue to produce the part. And you say, well, wait a second, we just saw a second ago that my total cost to produce this was $1.45. Exactly right. But 25 cents of that, or I'm sorry, 30 cents of that in this case, was actually going to be incurred regardless of me making the part or not. Because of that, what I see then is that when I only look at the part relative to what would be able to be eliminated, well, that's only 20 cents. So I would be saving $1.15 to pay $1.20. That's not a good business decision. And because of that, we will continue to make the part. Now, in this case, we of course need to look at another decision, which is called sell or process further. So this is where we can choose to sell a partially complete unit or to continue the production process and actually generate a complete unit. As a general rule, right? So this is my rule. We will process further only, right? Only if the incremental revenue exceeds the incremental cost. If not, we sell it right now. So Fast Track has 40,000 units of partially completed product Q. Processing costs to date are $30,000. These 40,000 unfinished units can be sold as is for $50,000, or they can be processed further to produce finished products X, Y, and Z. Processing further will cost an additional $80,000, but will yield total revenue of $150,000. So basically my question here, should we go for X, Y, and Z, or should I go ahead and sell product Q? So in this case, if I sell as product Q, my incremental revenue is $50,000. That's what they told me I would make. You'll notice my incremental cost is $0. And you say, well, wait a second. On that previous slide, they told me processing costs to date were $30,000. True. But what do we know about that $30,000? Am I getting that back? No. So that $30,000 is sunk. Because that $30,000 is sunk, I do not consider it in this decision. So we go ahead and continue. And we now look at my other alternative. You'll notice my incremental revenue here is $150,000. But what we'll see then is that whenever I come through this process to generate this much higher revenue, it's going to cost me $80,000, giving me incremental income of $70,000. At this point, all I have to do is ask one of the easiest questions all semester. Well, what's larger, $50,000 or $70,000? That's the alternative I want. So in this case, I will select the alternative, the higher income. And in this case, we should process further because doing so will generate an extra $20,000 in income. And once again, you'll notice that $30,000 was excluded because that was sunk. And as we said before, sunk costs are not relevant. Now, my next decision involves another common situation that we'll run into, which is I've produced a product, but it's not exactly right. Well, at that point, I've basically got two options. I can either scrap the product, get whatever I can for it in the current condition that it's in, or I can rework the product and try to recover some of the cost by selling this at the normal price, or at least a higher price than the scrap price. So in this case, Fast Track Notice has 10,000 defective units. They each cost $1 to produce. The units will be scrapped now for 40 cents each if we get rid of them at this point, or we can rework them at an additional cost of 80 cents per unit. If reworked, the units will be sold for the normal sales price of $1.50 each. So at this point, if I come in and I look at this, what I will see is that if I sell the scrapped unit as it is right now, I will get 40 cents. But because I'm not reworking the product, no additional cost is coming in. So I have incremental income of 40 cents. On the other side, if I rework this product, I have $1.50 in revenue that's coming in, but that's costing me an extra 80 cents to generate. So my incremental income here is 70 cents. Because of this, my incremental income is higher in this case under the option to rework the product. So I will actually rework my product. Now, before we continue, I just want to backtrack one more time, right? At this point, any cost that had already been incurred at that point would be considered sunk. So in this case, they told me that these 10,000 defective units had a cost of $1 each to make. You'll notice on my next slide, that dollar doesn't ever come in because it was already incurred. I'm not getting it back. It's another sunk cost. Now, for my next piece, we want to look at what is called sales mix selection. So I'm wanting to look at how do I choose which product to prioritize when I have limited available factors of production. So in this case, a company will sell a variety of products, and these are, of course, some will likely be more profitable than others. So how does management decide which products to focus on? Well, of course, we want to focus on the products that are most profitable. But how do we define most profitable? Is that just the highest amount, or is that maybe something else? Maybe what I'm really looking for here is to see that I'm not just generating the highest absolute amount of profit, but the highest profit per unit of constrained resource. So in this case, if production facilities or other factors are limited, producing more of one product, of course, will mean producing less of others. In this case, management will need to identify the most profitable combination or sales mix. And so management will focus notice on the contribution margin per unit of scarce resource. So it's not just the total profit or the total contribution margin, but it is that contribution margin per unit of scarce resource. So in this case, Fast Track makes and sells two products, A and B. A and B have the following sales prices and variable costs. You'll notice that product A generates a contribution margin here of $1.50, while product B generates a contribution margin of $2. So right away, when you look at this, you might assume product B is the product I want to focus on. But what you'll notice is if we look down in the table, that my machine hours per unit under product A is only 1 hour per unit. But under product B, it's taking me 2 hours per unit. So the actual product that is more profitable in terms of that constrained resource is product A. I'm generating $1.50 for every machine hour versus $2, but it takes 2 hours. So it's $1.50 per hour versus $1 per hour. Well, in that case, of course, $1.50 is greater. So for product A, 1 hour to produce 1 unit, and that's what we see here. And for product B, 2 hours to produce 1 unit. We'll then calculate contribution margin per machine hour, as we just saw. And what we'll see then is that if demand for our product is limited, we will first produce the most profitable product, notice per unit of scarce resource, up until we hit estimated demand. After that, I will switch to my next most profitable product per scarce unit of resource. Then I will produce up until I hit demand there. Then I'll do the same thing for the third item, the fourth item, the fifth item, the sixth item, the 100th item. But this is what we should be doing, is trying to figure out whatever that constraining resource is, and then figuring out which products I should be prioritizing to maximize benefit from the use of that resource. Now, my next major decision in this chapter involves what is called segment elimination. So when I look at segment elimination, what we see is that a segment is candidate for elimination if its revenues, notice, are less than what? Does it say less than total expenses? No, it doesn't, right? Be very careful. A segment is a candidate for elimination if its, notice, revenues are less than avoidable expenses, avoidable being the key here. If I can avoid this in cost, then I'm better off, right? If I can avoid enough cost. If not, then I might actually be better operating at this continued loss for a little while until either this switches around or we actually start making a profit again, right? But it may actually be better to ride this out. Now, notice avoidable expenses. These are the amounts the company would not incur if we eliminated the segment. But unavoidable expenses are the amounts that would continue, right? Even if the segment was eliminated. Now, of course, we understand that we will have some costs likely under both of these. And we are told here that Fast Track is considering eliminating the treadmill division because it reported a $500 loss for the year. So when I look at my statement here, I can see that my operating income was a $500 loss for my treadmill division. Now, in truth, I'm not thrilled with that, right? It is a loss. I'm not exactly happy. But the question is, should I actually eliminate the product or the actual line? So in this case, let's look at a couple of key pieces of information here. I have sales of 47.8. You'll notice that I have avoidable expenses of only 41.8, and then the remaining 6,500, of course, is unavoidable. So I wonder if that's going to impact my decision. So let's go ahead and move into my next piece. So sales minus avoidable shows me that there's $6,000 in income that I'm generating from this area to help me cover some of those unavoidable expenses. Now, in truth, I'm not covering them all, right? If we go back and look, I'm only generating $6,000 between this 41.8 and my 47.8. My unavoidable is 6,500, so I'm not covering them all. And because of that, that is where this negative operating loss comes from, where that actual loss is coming from. But the idea is, because I am generating something to help cover a portion of that unavoidable, even if I eliminated this department, I would still be incurring that 6,500, but I would now no longer have the $6,000 to help cover. So what I would actually see is a decrease in income by eliminating a non-profitable department, in this case, in the amount of $6,000. So what we say here is that the segment will be a candidate for elimination. Notice if revenues are less than avoidable expenses. And in this case, we will say we will not want to eliminate that treadmill division. Now, the next option or the next decision that we have to look at then is, of course, to keep or replace the equipment. So Fast Track, of course, currently produces Part 417, assigning overhead 100% of labor with the following unit cost. Now, notice that if I buy a new machine, this machine will cost me $100,000. The cash received on the trade-in this case, getting rid of my old machine, is $25,000, and I expect that each year I'll be able to save $18,000 in variable manufacturing costs because this new machine is more efficient. Well, that tells me that my reduction in variable manufacturing costs in total is $72,000, plus my $25,000 in cash received means I'm getting $97,000 worth of value, but I'm giving up $100,000. That means that my income will actually decrease if I buy this new machine. So in this case, I would not want to replace the machine. Now, let me ask you, do you see any problems or any flaws or oversimplifications in this calculation? Because I see one that just jumps right off the page at me. What do we see here? Well, the cost to buy the new machine, that would be incurred today. So it seems to me like the $100,000 is fine. I would also be receiving the cash today. So that seems like it's okay to come in at the full 25. But you'll notice this reduction in variable manufacturing costs is over a 4-year period. So what that tells me then is my actual savings there is not 18,000 times 4, because over that 4-year period, we will likely incur some inflation. We'll likely incur some reinvestment risk. We'll likely incur all sorts of things that are going to reduce the value of that savings. So in truth, what I should be doing is maybe pulling in some present value type calculations here to see what my actual savings is. Now, in this case, it doesn't make a difference. It's still unprofitable. But let's say that that was going to save me $19,000 per year. Well, in that case, 19 times 4 would change this highlighted number here to 76. Well, 76 plus 25 is 101, and then it would look like we would actually have an increase here of $1,000. But do you see the problem with that, right? it's showing me an increase of 1,000, but it's not true because this is not truthfully the 76. It should be less because a dollar received tomorrow is worth a dollar or is worth less than a dollar received today. So in practice, this is a decent way to get a general idea of what's happening. But if it's kind of borderline or kind of close, you certainly want to dig a little bit deeper. Now, for my next piece here, we want to look at our pricing decisions. So managers must consider these factors. So when I'm setting my prices, what all do I need to think about? Target profit, of course, right? What do owners expect? What is the ROI that we are being told we have to hit? How much will customers pay, right? So let's start to bring in some of that economics. So how does demand look? How does supply look in the market? How much will they pay? And how elastic is their demand? If I increase prices by 3%, am I going to lose more than 3% of my sales? If I am, don't do that, right? But if I can increase my price by 3% and only lose 1% of unit sales, that's a good thing to do because that's going to result in an actual improvement to my financial situation. Now, competition, right? Some markets incredibly, incredibly competitive. Some markets not very competitive because if I'm the only one, for example, that's selling a product, then to some extent, I do have the ability to charge what I want. Now, we recall from our economics courses, right, that even in a monopoly situation, I don't get to charge anything, right? So if, for example, I am, say, a large diamond company, I believe it's De Beers, that has like 90%, or at one point they had like 90% of the diamond mines in the world, right? So they had a pretty strong stranglehold on the diamond market, but that didn't necessarily mean they could charge anything they wanted to for a diamond, right? If De Beers had decided that for, say, 1 carat diamond for an engagement ring, they were going to charge $200,000, yeah, they may be the only one with that, but I'm pretty sure people can find a substitute for a diamond, right? We might start giving ruby engagement rings or emerald engagement rings or something else, right? But we would certainly look for an alternative because at that point, it just wouldn't be worth it to the vast majority of their consumers. So even within a purely monopolistic or an almost purely monopolistic area, there are still hard caps that the market can put on these monopolies because consumers will just stop buying the product, right? If, for example, when the iPhone first came out, right, sure, they were the only smartphone on the market. But if they'd been charging $10,000 per iPhone, it wouldn't have mattered that they were the only one with the product. No one would have been buying it, at least not in the same numbers that they were now. And it would have been a terrible business decision for them. And so we see this, we understand that even if we have a monopoly, while they do have more ability to set their prices, it's not absolute, right? Because people will actually find, typically, if we can, some type of alternative. Even if it isn't quite what we wanted, if it's so much more affordable, it's the option I will choose. So we will have to consider things like that. Now, differentiation. Of course, companies with well-known products or brands do get some additional price setting power. So for example, Nike and Under Armour, right, in the clothing and in the sports world, right, they have a lot of powerful name recognition. You throw an Under Armour or a Nike logo on almost anything, the price on that item just shot through the roof, right? You could have the exact same pair of shoes with some generic logo that is not the Nike swoosh or the Under Armour symbol, and I guarantee you it's going to be considerably less because it doesn't have that powerful brand recognition. So this is an important thing for companies to recognize, right? If I want to be able to charge more, I need to make my brand noteworthy. I need to make sure people understand who I am, what I stand for, all those types of things, and it gives me a little bit more power in that marketplace. And of course, product life cycles. So many products, of course, come and they go. And if you have one of those products, it's very important that you understand that that's the type of product you have, right? There's all the time, especially if we talk about toys for young children, right? There will be some amazing toy that fascinates 3 and 4-year-olds, and in 6 months is gone, right? We never hear of it again. But for that 6-month period, whoever made that toy was really cashing in, making good money. But very quickly, just as soon as that product appeared, it disappears. Very short product life cycle. But when we look at stuff that it has a longer product life cycle, right? Maybe certain cars or SUVs, or maybe we look at, certain technology. So just maybe not the individual piece itself, but in general, smartphones, right? pretty long product life cycle at this point. They've been going for a while. People still like them, right? And so if we know that that's the type of market we are in, then it might make sense to make our decisions a little bit differently than if I think I've only got a few months to make as much money as I can, and then this product's going away. So all of these things are certainly things we do want to consider. But our first method here, when we start looking at my actual pricing decisions, is what is called a cost plus method. So a cost plus method is very common when companies are price setters. So management will add a markup to cost to reach the desired price. Now, there are several ways to do this. The first is what is called the total cost method, where management sets price equal to the product's total cost plus a desired profit on the actual product. So there is a three-step process for this total cost method, and this is to determine the total cost per unit, then to determine the dollar markup per unit times my actual markup percentage. Then we will actually come down and set that selling price per unit. So in this case, let's look. We are told that we have variable costs per unit. You'll notice product cost $44, selling and admin $6. We have fixed overhead $140,000, and then fixed selling and admin for $60. So my product cost plus my selling and admin. Well, my product cost 44 times 10,000 in this case, because I'm dealing with 10,000 units, plus 140,000, plus my 6 times 10,000, plus my 60,000 fixed selling and admin. This gives me my total cost. So $700,000 divided by 10,000 units. Well, that is $70 per unit. In this case, I'm told I want a 20% markup. That's a $14 markup. Then I'll simply add the two pieces together, 70 plus 14, coming out to $84. Now, for my next piece, we want to look at what we might use when I'm actually in a highly competitive environment. So in this case, we'll talk about target costing. So in target costing, we want to actually deal with when we are what is called a price taker. So under my total cost method, I'm a price setter. So I have some ability to influence my price. Here, we are assuming something similar to a perfectly competitive market. All right, consumers have perfect information. Everyone's fully aware of everything all the time. We all produce an identical product, very little differentiation. All those items that we talked about in our economics, right? Courses, that ties in very nicely to accounting here. But that's where we're seeing this come in with this target costing method. So in this case, we're told the market price for an MP3 player is $80. Because I'm a price taker, I can't change that sales price. So if I want to determine the amount of profit I make, the only thing I can fix is my cost. So in this case, MP Pro wants a profit of $16 per unit. So we must reduce total cost to $66, right? If I'm only able to sell at $80, I want a profit of $14. That means my cost cannot exceed $66. So if MP Pro wants a 14% return on its invested assets of $1 million, target profit, of course, $140,000, $14 per unit if 10,000 units are sold. So that market percentage, 14 divided by 80, should come out to 17.5%. So that is what we see here. Now, for my next method, we want to talk about the variable cost method. So in addition to the total cost or the approach of the cost plus method, one additional method that we can actually use is to base price on variable cost. Because variable is less than total, companies that use this method will actually adjust their markup percentage, right? So we'll typically see a higher markup here. So factors that help us to determine price will include consumer preferences and competition. So in this case, my markup percentage will be my target profit plus my fixed overhead plus my fixed selling and admin expenses divided by my variable costs. Well, in this case, my target profit was $140,000. I had fixed overhead and fixed selling and admin of $140 and $60 respectively. So that is $340,000 on top, and divided by, in this case, 44 plus 6 is 50. 50 times 10 is 500,000. So we have on the top 340,000 divided by 500,000, coming out to a markup percentage here of 68%. So in this case, my sales price will be my $50 times my 68% markup, and that is, of course, $84. So Other pricing, we've got what's called value-based pricing. So we focus on what consumers value. This approach will determine the maximum amount consumers will pay without reducing their demand. We also have what's called auction-based pricing, pretty much exactly what you would think, right? This is essentially when I put something up for auction and we just sell it to the highest bidder. All right, so rather than forcing sellers to set prices, this approach will allow the buyers to actually go with this. Priceline uses this sometimes to sell hotel rooms and airline flights. We also see what's called dynamic pricing or surge pricing. This uses prices that vary depending on changing market conditions or customer demand. Now, this is something that we are certainly allowed to do, but it sometimes gets a very, very ugly press. So, for example, all right, companies that use this effectively and don't really get in too much trouble for it, something like Uber, right? During a peak time of travel in a busy city, you will pay more for your Uber than you will during a downtime. It just is what it is, right? There's more demand, there's more people requesting the service. There may be more people providing the service, but it may not keep up. So typically you will see a higher price with those Uber lifts or the Uber and the Lyft services and all those things during peak tourist seasons in a lot of these big cities. But this is essentially what happened during the big snowstorm that we had a couple of weeks ago here in Texas, right? Or a while back in 2021. What we saw then was a lot of people in Texas lost power. And at the same time, a lot of the power producing plants in Texas went dark. Well, when that happened, as soon as people started getting power back, people started turning their power on because they've been freezing for days, right? So it wasn't a very safe situation. So what ended up happening was people would use all of this power at the same time that the production or the supply was extremely low. The people that were on these types of plans with their electric utilities ended up receiving massive, massive electric bills after the storm because they were using such a large amount of energy when there was such a small supply. This surge pricing jumped the rate per hour, per kilowatt hour through the roof. And so people started getting bills for tens of thousands of dollars where they would normally pay $100 a month or something along those lines. And so while this might be what they had agreed to when they originally signed up for whatever plan it is, it becomes a huge problem whenever companies start essentially price gouging in the midst of a natural disaster. Even if they are following the contract that everyone agreed to, it creates a very ugly look in public appeal, right? And so it created a lot of bad press for a lot of these companies, and it created a lot of hard situations and hardship for the individuals that were receiving these bills and trying to figure out how on earth they're going to pay them. And so dynamic pricing or surge pricing, right? We can use it as a company, but you have to be aware, right? Sometimes, even if someone agreed to that, right? If something that's never happened before occurs, right? A once in a century blizzard hits that people just weren't prepared for, right? And companies just weren't prepared for it, then maybe we need to show some grace in those times. And so we see this happen occasionally, but it is certainly something we want to consider. All right, so it is another option that we have to essentially allow the demand for the product to set the price very actively, right? So very, very quickly seeing those price changes. Now, one of the last areas in this chapter is this idea of a special offer. So the decision to accept additional business, notice, will be based on what is called incremental cost and incremental revenue. So as we've seen all chapter, it's just incremental things that we're worried about here. And as usual, these incremental amounts are the amounts that will occur if the company decides to accept the new business. So in this case, Fast Track currently sells 100,000 units of its product. They're operating, notice, at 80% of full capacity. The company has per unit and annual total sales and costs as shown in the following contribution margin income statement. So I can see that on a per unit basis, I typically generate about $2.40 in contribution margin, coming down to $1 in operating income at the end. So about a 10% profit margin. Now, in this case, we'll see that the current buyer of Fast Track's products wants to purchase additional units of its products and export them to another country. The buyer offers to buy 10,000 units of product, but notice at $8.50 per unit, or $1.50 less than the current price. So the offer is incredibly low, but we are considering this because it would be several times larger than any single previous sale, and we currently have idle capacity. So should we accept the offer? Well, in this case, to determine whether to accept or reject this order, management must know whether accepting the order will increase income. So in this case, we look, well, if I sell the 10,000 units at 850, that generates a total additional sale of $85,000. You'll notice that my variable costs are similar to what we saw before. The 350, the 220, all those pieces, right? All that is staying the same. Now, what we'll notice though down here toward the end is that I will actually have all of my variable costs remaining the same. My contribution margin certainly is changing because my sales price has changed. But my variable costs are the same, coming down to a nice contribution margin of $2.10. What you'll notice though is that my fixed overhead, well, that really isn't incurring very much cost at all here, right? On a per unit basis, the only thing I'm really seeing is some additional admin expenses. And this is just because the textbook tells us that there are some additional clerical costs that will be incurred here for some admin, right? So this is an additional fixed cost due to this order. And so we would have to consider that, but that's only an extra 10 cents per unit. So I still have operating income in this case of $2 per unit. Now, because of that, we will want to accept the offer because I'm actually still generating positive income. Now, there are some things that we would want to think about in practice. Does this set a precedent for this customer to think that's the new sales price, right? I hope it not, because if I'm trying to cover my total cost, then I would need to consider all those fixed items, and then this is likely a bad deal for us. But in this case, I had idle capacity. I'm making sure that they know this is a one-time deal, right? I'm hopefully not advertising this to my other customers who would then want this same price going forward. So we have to be kind of careful with special offers in practice, but this is what we're seeing here. Okay, in this case, it does work out positively for me to actually take this special offer. Now, my last area here is what is called the time and materials pricing. So time and materials commonly used to price services. So companies will set a price for labor, materials, and overhead, plus, of course, a desired profit margin. Follows some general steps. I'm not going to get too lost in the weeds on this one. It's certainly not something that is heavily tested in here, but it is something I want you to at least be aware of. So just roughly familiarize yourself with this area in the textbook, and that should be good enough. So we first want to compute the rate in dollars per hour of labor. This rate, of course, will include a charge for any other overhead costs. We will then want to compute what is called a materials markup, including the overhead costs related to buying, storing, handling materials, plus, of course, another desired profit margin on the cost of my materials. That will typically be expressed as a percentage. We will then estimate the number of labor hours and the total materials cost for the service. Using 1 through 3 above, we will then compute the price for the actual service by adding everything up. But that's really it. So I typically don't get too detailed on this. We don't work too many problems related to this. It's not super heavily tested, but you certainly might see a question about, for example, which of the following is not a step involved in time and materials pricing, or something along that line. But typically not anything overbearing. And if I was going to give you a question asking you to do this, it would be fairly straightforward. So I don't think this is an area to get too concerned about, but certainly something you do want to read through. So in this case, the rate per hour of direct labor, we'll see my direct labor rate per hour, $40. My non-materials related overhead, in this case, was $10. So that is an hourly conversion cost of $50. We'll then add in my profit margin of $11. That is a $61 rate per hour of direct labor. In this case, my materials markup per dollar, well, they told me that my materials handling and storage comes out to 3% of my cost. I want a 22% profit margin, so that materials markup is 25%. Well, in this case, when I come down and put through all the numbers, we will see the job is estimated to use 300 direct labor hours and $14,000 worth of direct materials. In this case, we use time and materials pricing to set the price at $35,800. So of course, we'll see my direct materials cost of 14 pulling straight in. My 300 labor hours times my $61 is 18,300. And then of course, my materials markup of 25% for the 3,500. Adding all of that up comes out and gives me my total price for the job. So if you can work through this problem, and if you want to read through this section of the textbook, it gives you a little bit more detail on exactly how this works, then that may be a good thing to do. But that, of course, is the end of chapter 23. So if you have any questions, make sure to come to class with them or send me an email. I'll be happy to meet with you and help you work through them. But otherwise, we will meet up to actually work problems, assuming you're in, of course, one of my in-person classes, and we will do that. Otherwise, we'll see you next time. Thank you so much.